With hopes that the rising interest rates will reverse course in the future, we're going to take a look at the best Charles Schwab ETF funds to build a core portfolio to boost your retirement wealth. So stay tuned for the full episode. Welcome back. This is Richard with Wisdom Investor. I've got some good information I want to share with you here today. We're going to explore the Charles Schwab ETF funds that can help you build a core portfolio to build retirement wealth, whether you're young or you're old. Now you might be asking, I have a 401k, 403b, or government investment plan, and I don't have the option to use Charles Schwab funds. We're still going to look at some ideas and measurements that can help you build a good investment plan for your own retirement using other funds. Our main emphasis here today is to build a core portfolio, and we're using ETF funds from Charles Schwab. Now, before investing, one of the most important things to know is your investment risk tolerance. Now, we have a wide variety of people that watch this channel. We have expert investors and we have new investors to the investment world. It's very important to know your investment risk tolerance. Now, one way of knowing your risk tolerance, if you invest in something and you can't go to sleep at night, you're probably investing in something that's too risky for you. One way of measuring your investment risk tolerance here is what's called the beta. Now this sounds complicated, but it's very simple. Also, those investors who don't have access to Charles Schwab, you can use the beta to help you analyze your own investments. We're on the Yahoo Finance site and we're looking at the S&P 500 ETF SPY. We're going to go over here and click on the risk button, and up comes some information here we're going to look over. We're going to go down here where it says beta. The S&P 500 has a beta of 1. So the S&P 500 is typically used as the base indicator for the stock market. Now we switched over to the Schwab US Dividend Equity ETF SCHD. If we go down here for the beta, it says 0.87. Basically what that means is that the Schwab US Dividend Fund would have a return of 87% of the overall market. So it would not move as fast to the upside, and it also wouldn't move as fast to the downside when comparing it to the S&P 500. Now we're looking at the Schwab US Large Cap ETF. This has a beta of 1.02. We said the S&P 500 had a beta of 1. So this is greater than 1. So this has a volatility that could be greater to the upside than the SPY, and it also means it could have a little bit more volatility to the downside than the S&P 500. Before investing, we want to think about building wealth over time. Those stocks that go up quickly also have the capacity to drop very quickly. So we want to think building wealth over time. And the last thing is have a plan. When we talk about having a plan, we want to think about asset allocation. So what percentage of our retirement savings are we going to have invested in equities? Equities meaning stocks and ETF funds. Now this is a chart produced by Vanguard. On the left-hand column, we have the percentage of equities a person's invested in, 40 at the bottom, 90 at the highest. And then on the bottom axis here, we have age. Lower age to the left and the higher age to the right. Generally speaking, the younger a person is, the more they'll have invested in equities, stocks and ETF funds and mutual funds. When they get to be around 50 or so, we're looking at about 60 to 70% invested in stocks and ETF funds and mutual funds. The percentage in equities decreases as we get older. When we think about having an investment plan, we want to be diversified into different asset classes. So here's some major asset classes a person could invest in: cash, fixed income, stocks, real estate, commodities, and alternate investments. Generally speaking, when we talk about building a core portfolio, we're talking about being invested in stocks, ETF funds, mutual funds, fixed income like bonds, and maybe having some in cash. It's also good to have some type of a real estate investment like in owning your own home, and also invest in real estate through REITs, real estate investment trust. Now, as far as our investment plan and knowing our risk tolerance, here's a sample portfolio for a person that has a low risk tolerance and many times someone who's already retired. This would include 40% equities, 60% in cash and bonds. A median risk tolerance level would be 60% equities, 40% cash or bonds. Now, for the person who has a high risk tolerance, perhaps somebody that's older or more experienced investor, they might have 90% in equities, 10% cash and bond. For our conversation here today, building a core portfolio using Charles Schwab ETF funds, we're going to talk about using this medium risk tolerance here, and we're having 25% in dividend equity fund and 25% growth equities. Then it's optional. If a person feels comfortable, they could put 10% in a real estate REIT. Now, let me mention this about real estate and REITs right now. Interest rates are rising. Typically, rising interest rates are not good for real estate. I would wait until our interest rate environment changes so that we get into a lowering of the interest rates, and I think this would be a better time for real estate. Same way with bonds. I would rather have my money in cash right now versus bonds. Bonds react to the downside when interest rates are going higher. Our first fund that we're going to talk about here for our core portfolio is Schwab U.S. Dividend Equity ETF, symbol SCHD. Has a dividend yield right now of 3.2%, has an expense ratio of 0.09% and the beta of 0.87, which we talked about earlier. Let's talk about this expense ratio real quick. If you have an investment plan that does not offer Charles Schwab, understanding expense ratio is important. Here's the calculation they use to determine expense ratio. Total fund cost divided by total fund assets. Here's an important example to understand about expense ratio. In this scenario, we have $20,000 starting value, 5% annual return, no additional contributions. We're going to compare a fund that has an expense ratio of 0.25% versus one that has an expense ratio of 1%. Now, just to remind you, the Schwab fund we looked at a minute ago had 0.09% as expense ratio. So this fund would grow after 20 years to $53,095. The expenses over that time period are $2,471. That would put our total balance at $50,634. Now, the fund that has a 1% expense ratio, that would have a total expense of $9,243 over the 20 years of investment, and the value would be $43,852. The Charles Schwab funds are going to have a low expense ratio. Now, you can find some expense ratios on other funds and other companies much higher than 1%. So you want to watch that, know how much your expense ratio is. So back to our core portfolio, we're using Schwab U.S. Dividend Equity ETF to fit in here for dividend equities. We're looking at the top 10 holdings here for the U.S. Dividend Equity Fund. If you look at all of these companies here, these are name brand companies, and most all of them pay a pretty good dividend. Now, the advantage of you using a dividend fund like this, you don't have to go out and purchase all of these stocks. They do all of the research and investing. All you have to do is buy the one fund. Now, looking at our core portfolio here, for our growth equities category, we're using the Schwab U.S. Large Cap ETF. We're going to explore the Schwab U.S. Large Cap Growth ETF. Expenses are very low, 0.09%. The beta is greater than 1.02. So it's going to have slightly more volatility than the S&P 500. Now, that would be good if the market is moving higher. Now, what makes this a little bit more volatile than, say, the last fund that we looked at, the U.S. Dividend? If you look at the first 5 stocks and most of the stocks that are in the top 10 holdings here, they're technology stocks. Typically, the technology stocks are a little bit more aggressive. When we get into a situation where interest rates start to level off or start dropping, I like the U.S. Aggregate Bond ETF. Now, as a substitute for bonds, right now I would use some type of cash, whether it be a CD or treasury notes. Typically, they're paying in the range of 2 to 3% right now. When building a core portfolio for retirement wealth, whether using Schwab or another investment company, we looked at some measurements here to determine what type of funds to look at. Now, as far as investing right now, under our current market conditions, I would only be doing dollar cost averaging at this time. Somewhere down the road, we could get a full buying opportunity when we can do a lump sum investment at that time. But right now, the best form of building retirement wealth at this time is dollar cost averaging. Now, if you have any questions or input you'd like to add to the video, please do so. I hope you enjoy this video. Please stay tuned for our next episode.